That sounds like it's kind of deep.
No, it won't be.
Oh.
Are you ready? Hey guys, what's up? Happy Friday. Conversation Corner. This is number 107. My boy Ryan here. Oh, pound
107.
it. Pound it.
I like it. Allie, are we good? We're good. She says, yep, we're good.
Yep.
I mean, I'm kind of excited today.
It's March.
It is March, which I'm going to have to give my plug on March later.
Okay. March Madness? Is it a March Madness plug?
Okay, here's my plug. I'm not going to do it later. I'm doing a March Madness bracket that's going to be $10.
Oh.
And check this out. Look, Allie's already got it for me. Check it out.
Oh, nice.
A little ticket here.
Sunshine Kids.
$10.
Sweet.
100% of the proceeds is going to Sunshine Kids. And I'm going to give prizes away to the top 3 brackets. Now, I can't obviously have you fill out a bracket until after Selection Sunday, which is this Sunday.
Yeah.
So I'm going to give more details, but just so you know, stay tuned. That's my plug. Okay, I'm done with that. Let's go to Conversation Corner. Do you have any plugs that you'd like to get in?
No, that's good enough for me.
All right. So what kind of sparked this conversation today?
Yeah.
I was meeting with some clients, and
are we getting comments?
Allie's like, oh, here we go.
RJ says, hey Ryan, good to see you, bud.
What's up, man? Good to see you too, RJ. So what sparked this conversation was I was sitting with some clients. They're getting ready to purchase here, probably like April, May-ish. And they're like, hey, we're pre-qualified. And I was like, are you pre-qualified or are you pre-approved? And they're like, we're pre-qualified. And they're like, is there a difference? I was like, oh yes, there is a difference. And that is why I brought this man today to explain, Levi, what is the difference between being pre-qualified and pre-approved?
There's a huge difference, number one. Pre-qualify is like basically you have a lender pull your credit, you input into your application, if it's an online application, or you give verbal income information to the lender, right? So they're able to take a look at your credit and verify what your scores are, also verify what's on the report, and they can build out a theoretical debt-to-income ratio based off of what's on your credit report and what the verbal numbers are for your income that they give you. That's it. They don't verify anything. So why I strongly suggest pre-approval is that more often than not, you find gaps in communication, or people who maybe they embellish their numbers a little bit as far as income goes, or they might have something show up on a pay stub.
Wait, people don't do that.
Yeah.
Come on.
Yeah.
Did you guys catch that?
Yeah.
Say that again, because that's...
People might embellish on their income.
Okay.
The other thing, too, that happens a lot is people give us net numbers on their income instead of the gross figure. So someone might say, oh, I only make $3,000 a month, when in reality, maybe depending on what their withholdings are and things like that, they might actually make $5,000 a month. So there's a big difference there in purchasing power, what that income is going to allow them to have. So that's a huge thing. The other thing too is sometimes there will be, for instance, in the cases of alimony and child support, I've had a lot of clients where the alimony and child support did not show up on their credit, but it showed up on their pay stubs because it was being automatically withheld every single month from their pay stub. This is an issue because if it doesn't show up on credit, you don't know to count that against the debt to income ratio. And that can create problems down the road with the loan. So pre-approval, guys, is basically the lender. Not only do we go through the credit fully, do a full review of your credit report to make sure that we understand everything that's on there, all the financial obligations that you have, and we also look for any nuances in addresses, credit inquiries, things like that. But we're also going to dive deep into your income to verify that we know what those numbers are, and that we're going to give you a real strong pre-approval and focus your purchasing power off of exactly what your reported income is.
Strong pre-approval.
No doubt. And then we also, another thing, we're going to verify assets too, because we want to make sure that we achieve what your goals are for your down payment and also your closing costs. So we want to verify where the funds to close are coming from in the process. That's another huge thing. Get that out of the way in the front end. That way, down the road in the process, it makes things so much smoother. We already have that documentation on file, and we can really present strong offers when working with the agent.
We have a question. From RJ. He says, does child support affect the ability to get a home loan? It shows on my paycheck what I pay as well as my credit report.
Great question, RJ.
Yes.
It doesn't technically affect your ability to get a home loan. You can still qualify if you have a child support obligation or if you have an alimony or support obligation. The only thing is the lender, we have to take that into account against your overall debt to income ratio. So give you an example, let's say you have a $300 a month obligation that's coming out of your monthly pay stub, and that's something that you're required to pay for at least the next 3 years, then we are going to count that into your overall debt to income ratio. So it'll reduce your overall purchasing power a little bit, but it shouldn't affect your ability to qualify for the loan as long as you don't have any judgments or anything like that. Hope that helps.
Question on, or elaborate.
Yeah.
Because I think some people, we throw these terms around because we know them.
Yeah.
But debt to income ratio,
Yes.
what does that mean?
Thank you. Sorry.
Yeah.
So debt to income ratio, guys, that's basically your debt to income ratio. There's a front end and a back end. The debt to income ratio as a whole.
RJ says thanks.
Okay, cool. The debt to income ratio as a whole is going to be everything that's reported on your credit, your monthly obligations, which are credit cards, any installment loans, which could be personal loans or like car loans. Basically, all of your obligations that you have to pay that are reported on credit, versus, along with your housing obligation, and then versus your income. So it's everything reported on credit, plus your proposed mortgage payment, along with anything versus your income. Kind of stammering there. Hope that makes sense.
So as far as percentage-wise, what's a good percentage on average that most people are in when they're going through that as far as their debt to income ratio?
Great. That's a fantastic question. So there's a lot of different loan products out there, guys, and that's where your lender will help you search for the ones that are going to best suit your goals and will meet your needs. I'll give you a couple examples, just glaze over the real common ones that most people know. So like on a conventional loan, the standard back-end debt-to-income ratio cap is going to be 50% for a mortgage banker like myself. So it's going to be 50% cap on a conventional loan, meaning your mortgage payment cannot exceed 50% along with your other obligations. You can't exceed 50% of what your total gross monthly income is. Okay?
So if let's just say that my debt to income ratio is 56%.
Sure.
Are you saying then that there's going to be certain debts then that I need to get rid of before I'm able to move forward in that?
Question.
Or let me elaborate too, is because I've had a person that went and said, I'm going to pay off all my credit cards, I'm going to pay off all this stuff in order to free up more space for me to go and purchase my home and not be tied down.
Sure.
And it actually affected his credit score in doing that.
Yeah.
So can you kind of elaborate on those things too?
So if you're over 50%, we're going to look at different loan options for you. FHA loan, for instance, which is the Federal Housing Administration, it's an insured mortgage. They allow a back-end debt-to-income ratio up to 56.9. We call it 57 because essentially that's what it is. So that one we could probably look at in that scenario you talked about without having you have to pay off debts or transfer money or anything like that.
Cool.
FHA is a really good product. A lot of first-time home buyers utilize that one because it's going to give you a lot more purchasing power, and depending on what your credit is, usually much better interest rates than a conventional loan will also. As far as paying off debts go, we can definitely look at that as an option if you are trying to increase your purchasing power. Maybe your debt to income ratio and your income will only allow you to buy a $100,000 house, and you want to try to get something 120, 140, 150, but you need to pay off some debts to do that. We can definitely explore those together and see which ones are going to make the most sense to get you into your target purchase price. As far as it affecting the credit, paying off an account can temporarily affect your credit negatively if you pay it off. If you pay it off and close the account, right, it could negatively impact it. However, I will say credit's got a pretty crazy algorithm. So if you're already above a 50% threshold for whatever the account is, let's just say it's a credit card, you got a maximum available balance of $3,000 and you have $1,700 on the card, then you're over that 50% threshold, and that account is already negatively impacting your credit because you have a really high usage. So paying that account off actually might benefit you in that scenario. It might be a better improvement for your credit than it would be a detriment.
So
we have another question.
Let's go for it.
From RJ again. He asked, or he said, I've never had a credit card.
Okay.
I know he's just never liked the idea of credit.
Yeah.
When he could pay cash.
Yep.
Anyhow, my
Amen,
credit...
Dave Ramsey, baby.
Yep, love it.
Anyhow, my credit score is awful solely because I've never had credit, but have a couple of medical bills and child support obligation.
Okay.
Where should I start in order to get on track to homeownership?
Great question.
That is. Do you want to take this one, or you want me to keep going on that?
Well, I'll try to answer it, and then I'll let you step in, because he's the lending pro. I'm just the real estate agent. So to be honest, like if I'm having this conversation with someone, I'm going to advise them based off of what I would do and my knowledge of what I've learned from Levi and other lenders. But I'm always going to basically pawn that off on you and say, hey, talk to your lender, or talk to my boy Levi, because he's going to have a better idea and be able to look a little bit deeper into those numbers. But to answer that question, I'm a firm believer too, where I like to not have a lot of debt. I don't like being strapped. I don't like getting into a house and then feeling like, man, if something major happened, I would be strapped and I don't know if I'd be able to make my mortgage payment or what my car payment or whatever. I'd never want to be in that situation. So for me, like, I'm always looking at, okay, I'm kind of laying out my debts, basically. When me and Vanessa got married, we kind of laid out, like, all of those debts, and we said, okay, here's all of our debts. Here's the ones that we wrote out the interest rates on them. So, like, we put the ones that have the highest interest rate at the top, and then kind of move them down. And so we basically said, okay, let's try to knock out the one that has the highest interest rate first. And so that's what we started doing. So we started paying off cars, we started paying off credit cards, some of these other things. And then now, we like to pay cash for everything, but we use a credit card for, like, our gas every month, and then we just pay it off. We've got disciplined in doing that. Some people aren't as disciplined to do that. So if you know that by having a credit card, it's going to, like, tempt you and make you go spend money that you don't have, then I would advise not to do that. There's other ways, from what I've learned, there's other ways that you can build your credit up without having to buy a credit card. And I'll let you maybe speak into that.
So RJ, to answer your question, I would totally depend on your individual scenario, but my best suggestion would be kind of echoing what Ryan's saying, but we'd have to determine if you have no credit or if you have bad credit, because there's different things there. So you said your credit score is probably not the best, but is that just because you have a lack of credit, or is it because maybe you have some old derogatory stuff that's still on there? If it's the latter, you have a couple of collections or something on there, I would say first and foremost, you need to start by pulling your report. Now, I could help you with that. Otherwise, you can get a free report every year from each one of the bureaus. You can do those online. It's pretty easy. They'll give you a free copy of your report so you can find out what's on there. You could also use a service like Credit Karma to monitor your credit. They won't give you a copy of your full report, but they'll help you monitor the activity that's on there. What I would first do if I were you is find out what's on your credit. If there's negative stuff on there, you need to get rid of the negative stuff. That's the first step to start to build credit. So if you have collections, call those companies, do an offer and compromise. If you got, a $200-$300 medical bill or something like that that's been following you for years, just call them and say, hey, I got $50. Can we put this thing to bed? They may not take it. It may take you a couple of phone calls to get that to work, but chances are they'll ultimately settle with you at less than what you owe. So that's step number 1, I would say. Step number 2 is once you get that stuff paid off, make sure you have in some type of a free account that will allow you to monitor your credit, like a Credit Karma or something like that. Get your Credit Karma account set up. Use that account to click on, they have what's called a My Recommendations tab, and they'll recommend accounts for you, secured credit cards or regular credit cards based on your credit profile that will help boost your credit score.
Mm-hmm.
Now, I have to echo what Ryan says. I hate establishing debt. I don't want to have credit card debt, things like that. I don't recommend it. Unfortunately, though, in order for you to establish debt, you got to first have debt. It's kind of a goofy system that we live in.
It
so
is.
in order for you to be able to, have a car loan or a mortgage or something like that, you have to have an established credit history. Okay, so one of the best ways to do that, get a real small credit card. You could do that, use Credit Karma to do that, and then just keep the balance really low. If you keep it at 0, that'd be a good thing. If you put $10-15 on it a month and paid it off every month, that would also certainly help you. Another thing I recommend to a lot of clients, I know I'm rambling here on my answer, but if you have a spouse or a significant other or maybe a parent who has a really good credit history, you can have them add you on their accounts as an authorized user. Now that's going to help you boost your overall credit score because you're going to get to piggyback on all that really good credit history that they have. And authorized users are a really cool thing because they're not going to send you a card. You're not going to actually be able to use that credit. You're just going to be able to piggyback off of all that really positive credit history. So after college, when I was building up my scores, that's what I did. I had my parents, along with my spouse, add me onto their accounts so I could really start to boost my credit up that way. And that was a huge, huge help. It doesn't cost anything. It's free. You just got to convince a family member to want to do that for you. So that's a really good way that might boost your score pretty quickly. Another thing is it's really easy to build your credit score up. When you have a lower score, certainly in the 500s or even in the low 600s, it's really easy for you to go from that amount up to 680, even 700. You can do that pretty quickly. What gets tough is once you get to 700, going up into the 750, 760, 780, even into the 800s. That's what can take several, if not maybe even up to a decade to get that type of a score. You got to have a lot of really strong payment history for a lot of years. So I hope that answers your question. You can shoot me a private message. Also, Ryan, if you have any follow-ups for us, we're happy to help you however we can.
Yeah, he said he just didn't. He had heard about the authorized user before, but didn't know if it was legit or not.
Oh, it's totally legit. Yeah, and I would recommend it. Like I said, you just got to convince whoever it is, to add you onto the accounts. But that could be a big help.
Yeah, amen to that. That's good stuff.
Matt said sick flannel.
It's not a flannel, bro.
Matt?
I know, it's just
a flannel pattern. That's
Come
okay.
on, man.
I still appreciate the love, Matt.
Jason Miner says, "Hey, Levi."
What's up, buddy?
And
man, I'm getting no love. My people.
And then he asked how it's been too.
Good.
And then Heather said, "Great advice as usual. Always look forward to life coaching sessions."
Oh, love you, Heather. Hey, so, which moves me, we can kind of close out on this, because we always do. What is the market doing right now? And how can, since we're kind of talking about the pre-approval stuff, why would you recommend someone to get pre-approved now and to start buying a house now, as opposed to waiting?
Well, that's an awesome question. I always recommend pre-approval as the first step to looking into the home purchasing process. It's a huge thing. There's so many things that we uncover through the pre-approval, and we help really to kind of hone in on what your goals are to help you figure out what you really want to accomplish through your purchase. I mean, buying a house is for most Americans is the largest financial transaction they'll ever make in their life. So it's really important to plan for that and start early rather than later. You don't need to wait till the last minute. I have clients who are 18 months, even a couple years out, and we start the pre-approval process now because what we do is we uncover all the skeletons that are hiding under their credit, if there are any. We talk about, hey, how much do you have saved? Do you need to have anything saved? Is there a program out there for you? Or, what are your goals? And if they don't have any cash saved, they can start to plan on, oh, hey, maybe we want to put this amount down. Here's what we need to do to get there. So I recommend the pre-approval as the first step. Even if you got bad credit, I can run some reports to help you figure out what you need to do to boost up those scores, to work on it. Maybe it'll take you 2 months, maybe it'll take you 2 years, but at least you'll have that information and you know how to proceed, and you can set that goal in the back of your mind to start to move forward. So
I think that's good, because like I tell my buyers that every time I meet with them, that hey, I start working with people 3 to 18 months out. You know, so like from that first meeting to when I close, it's anywhere from 3 months to 18 months, just depending on where they're at and how ready they are and all that kind of stuff. And that's why I get people approved first, because in this market, so right now in our market, we've got about 1,700 houses on the market, and that includes new construction, which isn't a lot. So a lot of people are like, is that low? Is that high? Typically what we'd like to see is like 5,000 to 6,000 houses on the market. So that lets you know kind of where we're at. So we're back in a seller's market. It's looking that this spring and the summer is going to be that way, where you're going to show up. If you are buying, you're going to show up to a house and there's going to be 12 people there, 20 people there, and there's going to be multiple offers. We're seeing it already. Gosh, I was just talking to 2 other agents where they put their house on the market in less than 24 hours. They've got 6 offers and they've got 10 more showings. You know, so it's starting to pick up again. Yesterday, I wrote up on a house with some clients, and the agent was talking back and forth with me, and he's like, "Has your day been busy?" And I was like, "Yeah, I'm probably going to be riding up with 3 people today." And he goes, "It seems like somebody just turned the faucet on and it's coming." And I don't know if you're feeling that, but I'm feeling that. So a lot of people coming out, but again, we're running into the issue of now
inventory's
low. And so how does that affect you as a buyer? Well, as a buyer, it can affect you long term, because you might be writing up on 4 or 5 different properties before you finally get one. So when you think you might have been moving into a house in 3 months, it now turns into maybe 5 or 6 months. And with that,
you gotta be,
then comes interest rates.
Right.
So
you gotta be prepared, and you gotta be pre-approved.
Dude, I like that. I like it. I like it.
But as far as rates and stuff go, one quick thing just to kind of echo what he's saying. You know, even if you're if your goals are 18 months, a year, and you know that, that's great. Let's establish a budget. Let's establish your goals. Let's get the pre-approval done so you know what to focus on for your future purchase. If you're on the fence and you're like, hey, I could buy now, but the market's so crazy, I don't really wanna, I would say don't wait, because to talk about what Ryan's saying, things are not going to get better as far as the market goes. It's not going to just, hey, in 3 months or 6 months, it's going to switch to a buyer's market. That's not how it works. It's a very ebb and flow, and it takes years for those transitions to happen. Even with interest rates on the rise, which they certainly are, and they're going to continue to climb, which is another reason I would say, if you're on the fence, look at purchasing now, because it's going to make more financial sense to do it now than it will this time next year for certain. We have at least 2 interest rate hikes that are slated with the Fed, with almost 100% certainty for the one that's going to happen this month, and the following one's 75%, somewhere like that I checked. So for sure we're going to see at least 2 rate hikes this year. That's going to aid in increasing interest rates. Eventually, with higher rates, we will see home prices start to taper off, and kind of appreciation rates won't increase that much long term, but we're not talking about 6 months to a year, guys. We're talking about maybe 3 to 5 is when that plateau will kind of happen, and the market will start to catch up with itself. It's not something that happens quickly. And historically speaking, every time there's been a significant increase in interest rates like what we're seeing right now, home prices actually continue to rise. They increase even more because it pushes more people into the market. So I would say get in while you can. Let's get you hooked up. Let's get you pre-approved. Let's get you set up with a real estate agent who knows the market and can help you navigate the process, the home buying process, get you out there and get you making some offers on some properties.
Amen to that. Hey, happy Friday.
Happy Friday, guys.
Go Creighton. Go Huskers.
Show them socks.
I know. I got the Creighton socks on today.
Yep.
I should have worn my Husker socks because they're playing, and I hope they're winning right now, because when I came in here, they were losing.
Oh,
but
geez.
it's okay. It's Friday. Allie's shaking her head. She's like, you guys have been talking.
All right, guys. We're out of here. Have a great weekend. Enjoy the weather. It's going to be awesome. Get out of the house. Go do something.
Go do something.
Yeah.